Welcome back, everybody, to another episode of Multifamily Report, Market News and Industry Insights. I'm Travis Watts, the Director of Investor Development here at Ashcroft Capital. In today's episode, what we're talking about is what an election year means for multifamily real estate. Disclaimers as always, never financial advice, never going to tell you or anyone what to do with your money. So please always seek licensed financial advice when it comes to your own investing. Now, with that top of mind, election years have profound impacts on both the economy, they have impacts on interest rates and new policy, and no doubt it affects the real estate market and more specifically, the commercial real estate market. So in today's episode, what I want to give you are 5 topics to look out for as we go through 2024. And number 1 is economic uncertainty. There's a lot of uncertainty, which can lead to volatility, which can place a lot of investors on the sidelines with a mentality of, let's just wait and see. Let's just wait and see what the Fed does. Let's just wait and see who becomes president. Let's just wait and see what policies end up changing. And this ultimately just leads to decreased volume and activity in the investment space. And we would expect that as we enter Q3 and Q4, that slowdown will continue. As we're so close, we might as well wait and see at that point. Now, from an acquisition standpoint, we've already been seeing this play out through 2023 and 24 because of high interest rates. So in other words, sellers who already have a portfolio of properties are very hesitant to sell in today's high interest rate market because valuations are down to the tune of 20-25% on average in the multifamily space. So if you can afford to hold on to these properties for another year or two, you may find yourself in a better economy with a higher potential valuation. So this leads me to the final point on economic uncertainty, and it's the buyer's opportunity. If you can get a deal that pencils and that cash flows that you can pick up at a 20 to 25% discount relative to previous pricing, this is simply an opportunity to buy the dip. And this brings us to the second topic, which is interest rates. What's the Fed going to do? Well, no one has a crystal ball, including me, but what I can tell you is the summer of 2023 is when the Fed last hiked interest rates. And ever since, they've simply been on pause, and they too are waiting to see what comes of it. Now, the good news is that a long pause like this signals that we're at the top or nearing the top of the rate hike cycle, and nearly all the forward-looking forecasts from economists and the FOMC, and even if you go back and look at historics at what happens at this point, the forecast is for rates to come back down. So once the Fed decides to cut rates, even if it's a small amount, let's say 25 basis points or 1/4%, that will at least signal confidence into the market for both buyers and sellers. The third topic to look out for is regulatory change. During election years, there's a lot of policies and proposed bills and changes, and a lot of these affect real estate and taxation and zoning and evictions and things like rent control and affordable housing. So these are all key metrics to look out for. Now, once again, some investors will simply be on the sidelines waiting to see what policies come to be and which ones don't, and then they'll start investing after. Others may see some of these proposals as a bullish signal and want to jump in to get ahead of the curve, so to speak. And my final point on regulatory change is markets are super important. Real estate is a local business, and states and even local municipalities matter a lot. And that's why we operate here at Ashcroft Capital in landlord-friendly states where the odds are more in our favor in terms of evictions and rent control and topics like that. So we operate in Texas, Florida, Georgia, and North Carolina, all being landlord-friendly states. Number 4 is consumer confidence. Always a very important metric to pay attention to, because when we talk about consumer confidence, we're just talking about the average working everyday American, AKA our renters in our apartment buildings. So consumer confidence is how individuals feel about the economy. Are they getting squeezed by inflation and they feel like they're paycheck to paycheck and can't get out of that cycle? Do they feel prosperous, like they have extra money to go spend. Well, what we're seeing right now is that we're still teetering on the potential edge of a recession. I don't know if we're going to have one or not. There's a lot of debate over a soft landing versus a hard landing. But if we go into recession, that means that consumer confidence will go very negative. People will start to cut back and save a lot more, especially on big ticket items, such as someone being a first-time home buyer or looking to trade in their 3% mortgage on their current home for a 7% mortgage on a bigger home. We really haven't seen drastic price reductions in the single family space. So that dollar amount is a big factor for people to consider. And what's been happening over the last couple of years since the Fed has increased rates is that it's put a lot more demand on rental housing nationwide. In fact, according to CNBC, as of late 2023, the average mortgage payment is 52% higher compared to the average rent payment nationwide. And the final topic I want to discuss in today's episode is just government and policy at large. Depending on the political landscape, how it pans out by the time we reach November and what each party is promising, there's usually a lot of promises around infrastructure investment and public spending and new proposed bills. And of course, infrastructure investment and public spending is usually something that's bullish for the economy, and it can certainly help certain markets depending on what's being proposed and where. New bills can also help stimulate the economy. And I'll give you a practical example of a bill that just had an overwhelming majority vote by the House, and that was a proposal to bring back 100% bonus depreciation into the tax code. Now, this is something that President Trump put into play with the Tax Cuts and Jobs Act back in 2017. It really helped drive investment and demand in the commercial space for many years, and it began phasing out in 2023. It's phasing out a little more here in 2024 and a little more next year. And in a few years from now, it's set to go back to zero bonus depreciation. So if this gets passed, this could once again re-stimulate the commercial investing space. So as of now, all eyes on the Senate. So with these 5 topics in mind, it's important as an investor to at least have some information and knowledge and keep a small pulse on what's being proposed and what may transpire during an election year. Now, here at Ashcroft Capital, we are net buyers in this current market environment for reasons that I pointed out previously. We're buying at a discount. We're buying cash flowing deals. We're putting long-term debt on these properties. We're using lower leverage than we've used in previous years, and the fundamentals of multifamily remain strong. So to us, this is simply a buy the dip opportunity in the current market environment. As always, if you want to take a deeper dive, learn more, you can reach me at travis@ashcroftcapital.com. For current offerings and opportunities this year, please visit ashcroftcapital.com for more information. Please don't forget to like, share, and subscribe. It really helps the algorithm, but more importantly, it helps videos like these reach more investors like you. You're listening to Multifamily Report right here at Ashcroft Capital. I'm Travis Watts. Truly appreciate your time and being here. Have an excellent week. We'll see you in the next episode.